Good morning, ladies and gentlemen. Thank you very much for this kind invitation to this great conference, the CFO of the Year 2018 here in Budapest. And thank you for the great opportunity for me to present the Commerzbank macroeconomic views on the European and the global economy. Of course, the current question is, will the global economy further cruise or will be a great crash? At least if we have a look at the Eurozone economy. I've brought along the Purchasing Managers Index, the composite index for the services and the manufacturing sector. And at least for this one, you see it looks really devastating, doesn't it? It's not very optimistic. You see a steep rise. You don't see anything. You see a steep rise in 2017, and then you see a steep fall in 2018. But I've brought along with my presentation several theses, and my first thesis about the Eurozone economy is that we currently are in an economic soft patch. This will last for some quarters on, but the upturn will continue. This is the good news, and to my mind, it will at least stabilize and pick up a little bit in 2019. But still, at first glance, this looks very devastating and pessimistic. But this is our picture. We think that the purchasing managers in sentiment, or at least the business sentiment, will at least stabilize. There are several reasons for this. The first one is that we had really an exaggerated growth momentum last year. I mean, just have a look at this steep increase in 2017. To our mind, this was really exaggerated. So this downturn in 2018 was, to some part, some kind of normalization, correction back to normal. There are some other factors as well. Of course, you have several risks which emanated at the beginning of 2018. First of all, the trade war by Donald Trump and so on. We have some issues with Italy in the Eurozone. And another important factor we had at around here, end of 2017, starting 2018, a very, very strong euro, which of course dampened the exports, and it was a significant dampening of the exports. Until mid-2018, this headwind of the stronger euro has abated, and now we have a rather weaker euro, and we still expect a weak euro until year end, so that we have something where this headwinds from the foreign currency has changed into a slight tailwind from the currency, so that we also from this side think that we will see a stabilization here. And at the end of the day, we still have a very, very easy monetary policy by the European Central Bank, which of course creates a very investment-friendly environment for the economy. So this is the reason why we believe that we will see at least a stabilization, or that even the sentiment and also the economic growth will pick up a little bit. And then you can see this sentiment indicator, which is really a good indicator for economic growth, corresponds to a GDP growth rate within a range of around 0.3 to 0.5 quarter-on-quarter rates, which is absolutely okay and quite decent for a mature economy like the Eurozone. My second thesis is that the ECB will end its unconventional monetary policy at the end of 2018, and that we will see a very, very cautious first interest rate step in fall 2019. Because if we have a look at the glasses of Mr. Draghi, we see on the one hand quite good growth, although we are currently in a soft patch, but as I just explained, we are quite convinced that the upturn will continue, maybe a little pickup in the momentum. So we will have, on the one hand, quite good growth. On the other hand, the ECB will also recognize that the inflation rate will pick up. Because if we believe in the Phillips curve, as we do, and as also the European Central Bank does, we can expect that the good growth translates into into declining and low unemployment rates. This will further translate into a pickup in the wages, and higher wage inflation will at the end of the day translate into higher consumer price inflation. We see a first glimpse of these developments in several countries. In Germany, we have almost full employment. We have other strong economies as well, like the Netherlands. We have also almost full employment in the Netherlands, and there you can see that the wages have also already accelerated. But not only in these strong economies, you can also have a look at Spain, for example. You can also have a look at even Italy, even in the former crisis country Ireland. You can also see in the last 1 or 2 quarters a pickup of the wages. And as I said, if we believe in the Phillips curve as we do, this will sooner or later translate into consumer price inflation. The ECB also believes in this relationship and projects a core inflation rate of 1.6% in 2019. So this is what the ECB sees and what the ECB expects. Inflation picking up, going towards the 2% target of the ECB on the one hand, and on the other hand, quite decent growth of the Eurozone. So there is no reason at all to keep the interest rates at this low level, which we have currently. Our forecast is still that we will see only a very, very cautious interest rate hike in fall 2019. Particularly, we expect that we will have the depo rate from -40 to -30, with leaving unchanged the repo rate. And we also believe that afterwards there will be no typical rate hike cycle. So it will be a first step, a very, very cautious step, and then onwards we will see more or less nothing in several months. So the ECB will watch the financial markets, will watch the real economy, what happens on these markets. And only after several months there may be a second step, but it will be very, very cautious. Why is that? Because in our models, we expect that the inflation rate will not pick up as quickly as the ECB expects. We do not think that the core inflation rate will hit 1.6% next year on average, which would mean that at the end of 2019 it should be at around 1.8%. I think this is too high. Our models also indicate that the inflation rate will be much lower. So on this side, the ECB will be disappointed. But there is another factor we have also to consider, and the ECB considers this as well, that in several countries we have very high private and public debt. Let's take Italy, for example. We have public debt of 130% of GDP. This has increased in the aftermath of the financial crisis by 1/3. Just imagine it was at around 100% of GDP. Then came the financial crisis. Then the public debt exploded by 1/3 to more than 130%. At the same time, this is very interesting, due to the decline of the key interest rates, the debt service burden of Italy, so the interest expenses even declined. Although the debt stock increased by 1/3, the interest expenses declined. Thinking this in reverse, of course, if the interest rates increase, the debt becomes less bearable. The ECB is also aware of that. This is another argument for us to expect that we will not see a classic rate hike cycle starting next year. Leaving the Eurozone, looking across the ocean, brings me to my third thesis, which is the major risk to the global economy from my perspective is President Donald Trump. Of course, when I'm talking about risks and Donald Trump, we may all think of his international trade policy and currently his trade war with China. Of course, You don't know how this will play out. We will have to see. And he has also threatened that he will levy higher import tariffs on the total imports from China. We will see how this works out. But at the end of the day, we are talking about an import tariff of plus 15 percentage points. From a Chinese perspective, only on the exports to the United States. So all the other exports to the global economy are left unchanged from an import tariff perspective. At the same time, the renminbi has devalued a little bit, and the Chinese government is eager to counteract with several stimulus measures. So, of course, I do not want to play down this trade war, but at the end of the day, and having a more objective look at the issue, I think this, of course, will weigh on the Chinese exports, and of course, it will weigh on the Chinese growth overall. But I'm absolutely convinced this will not bring down the Chinese economy. There will be no recession due to this trade war between the United States and China. The bigger issue for China are, to my mind, the huge overcapacities. And this is exactly what our long-term view is. Our broad picture for China is that we will see over the next, say, 5 to 10 years, a slow but continued deceleration of growth. And this is basically due to these huge overcapacities. If we go back 10, 12 years, we already had overcapacities. You can have a look at each and single sector. You can have a look at the energy sector, the glass industry, the cement industry, steel industry, whatever you like. In each and every sector, we had back then already huge overcapacities, and these capacities have even widened over the past 10 years. This came along with several other imbalances, huge creation of private debt and so on, shadow banking system and so on. But these overcapacities, and this is an observation which we have over the last 1 or 2 years, they are about to be corrected. This is the good news on the one hand, because sooner or later an economy has to correct these overcapacities. But on the other hand, this also means that we will have a slow and slight but continued deceleration of the Chinese economic growth overall. I think this is the major issue for the Chinese economy, and the trade issue between China and the United States just adds on to this impact. So there will be no recession at all, but the trade war adds on. Talking about trade war, of course, Mr. Trump is currently focused on China, but sooner or later he will also focus, of course, on Europe, because he also doesn't like the trade deficit between the United States and Europe. But I think he will not be as harsh to Europe than to China, because one of the main drivers or one of the main problems, it's not only the trade deficit versus China, it's also a geopolitical issue. I think what he really dislikes or even hates is that China is becoming a superpower, a military superpower on the global level. By contrast, he doesn't regard Europe as a military superpower. By contrast, he even wants us to spend more to increase our military expenses. So this is one important difference. The second important difference is that he also doesn't accuse us of manipulating our currencies. He also doesn't accuse us of stealing intellectual property from the United States. And we have already shown in summer a willingness to communicate. Just think of the EU Trade Commissioner, Mrs. Malmström, who was over in Washington and offered to cut all auto tariffs to zero. if the United States do the same. So there is willingness to talk, there is willingness to negotiate, and I think there are many severe differences between the situation of China and the EU, so that we think Donald Trump will not be as harsh to us as to China. To my mind, the biggest risk is not his international trade policy. To my mind, the biggest risk for the global economy is the well-being of the United States. This sounds a little bit weird because we think that the United States will be in a very, very good shape. Because not everything is stupid what Mr. Trump does. To state it quite clearly, there are some policies which are, from an economist's perspective, quite okay. I mean, think about the tax cuts, think about the deregulation he did in the United States, think about the first steps in infrastructure investment. This will all push the United States economy. So we expect a good growth of the US economy over the next year, over the next 2 years. But this, of course, has also an impact for the Fed interest rate policy. We are already in an interest rate hike cycle, and we think this interest rate hike cycle will continue. We expect a further 25 basis point increase in December and further 3 rate hikes next year, each by 25 basis points. But this now, in turn, has a major impact on the emerging market economies. And if you have a look at that one, what we see in 2018, this is a chart which I've borrowed from the Bank of International Settlements. They have compared the current year, which they labeled trade tensions, lira and peso crisis. We could surely add the interest rate hike cycle of the Federal Reserve. They have compared the movements in several asset classes with earlier periods. And you can see that during the taper tantrum or the China 2015 jitters, we have similar equity losses among emerging market countries. We have similar FX devaluations. We have local currency debt spread, which is a little bit higher now. And we have similar spread of foreign currency liabilities. So there is currently stress on the emerging markets. You can also see that there is stress on the fund flows. We have here differentiated between equity and bond fund flows. You can see inflows into the emerging markets throughout 2017, also beginning of 2018. But now they have significantly turned. We have significant outflows since around April, May 2018, and also the emerging market carry trade index indicates that investments in the emerging markets overall is less attractive. However, my final thesis is that there will no be something like a full-blown or a general emerging market crisis. I think we have pretty much differentiate between several emerging markets. And my advice is, if we want to find out which emerging markets are the most risky ones or which may become the most under pressure, we just have a look at the devaluations since the beginning of the year. And I have 2 periods here. The yellow one is always the first half of the year, and the black one is the third quarter. And you can see that there are different riskiness. We have, for example, of course, the 2 exceptional countries, Turkey and Argentina. I have here the second scale. We had devaluations of around 40% or even 70% in case of Argentina. But we have also devaluations here in the first half of the year in South Africa, and it even accelerated in the third quarter. We had also a strong devaluation here in India. I mean, which country is, or how markets perceive the riskiness of each country depends on various factors. I do not want to bore you with details, something like that Mexico has a high current account deficit, or that India and South Africa have huge public debt and public deficits, or that Russia has huge foreign currency denoted liabilities. All doesn't matter. What you need to know, and if you are interested in how risky is one country, is one emerging market country, just look at these currency developments over the year, how they accelerated or how they decelerated, and then you will know which emerging market countries will come under pressure if this rate hike cycle from the Federal Reserve continues next year. Interestingly, what you also can see is we perceive these countries here as less risky, and among them is, of course, Hungary. Of course, there is general pressure on the emerging markets. This is why we had a devaluation here in the first half and also some kind of devaluation in the third quarter, which still does not add up to 10%, so this is quite okay. I mean, given the general pressure on the emerging markets. This is also why we perceive the Hungarian economy still a good place to invest. I mean, there are hardly any imbalances. Hungary has pretty much corrected or brought down the foreign currency liabilities. Inflation is in check. The central bank has a key rate of almost 1%, is about to stop its unconventional monetary policy, so there is enough leeway in the future to react in one way or the other. You have a quite decent growth outlook. Of course, growth in all countries of the world will not be as dynamic as we have seen in 2017, but still the upturn is continuing. This also holds true for the Hungarian economy. I mean, given the tax cuts in 2017, and also a promoting factor will be the additional capacities set up by large auto manufacturers. This will also contribute to the economic growth in Hungary over the next years. Let me just sum up my thesis again. The first one is, in the Eurozone economy, we currently witness a soft patch. But the upturn will continue, and we even believe in a pickup in 2019. The ECB will start a first cautious interest rate increase in fall 2019. The US trade policy, of course, remains a risk for the global economy, but I think the larger risk is the federal rate hike cycle. Of course, the US economy is faring quite well, but the Federal Reserve will proceed with its rate hike cycle, which is a peril to emerging market economies, but not to all of them, to certain emerging market economies. Thank you very much.